Hey, good afternoon, everyone. This is Trader Tim from over at eminimine.com. Today's Monday, the 17th of June, 2019, and we're doing a Monday market analysis video to kick off the week here in the E-mini S&P. I had the pleasure of spending the weekend in Seattle for a good friend's wedding and got to refresh a little bit, recharge. And so here we are with another week and an FOMC meeting announcement week at that. So what does that mean for us as day traders? Well, Wednesday afternoon will be when that announcement comes out. Uh, Not looking like there will be a rate cut at this meeting, but there have been indications that the Fed will actually cut rates, which definitely seems strange in a market or in an economy that's uh, doing so strong in the stock market, a very strong stock market, as well as very low unemployment. So we'll see how kind of the tone of their announcement on Wednesday, how the market reacts to that. But on Tuesday, tomorrow, typically we end up with sort of a neutral day like we have had today and on Friday. And really, the last couple of weeks, with this rally, it almost feels like the market is waiting for that announcement before it either makes its larger pullback to the 50% or if we're gonna, rip through the highs up here in ES 2956. Originally, I was expecting, a rollover and a pullback to the 50% at 2820. But the longer we kind of stay in this sideways formation or the bull flag, the longer or the more likely that the market does actually go higher from here. You can see this swing high taken out. If you were to, if we were to picture that this was a very small time frame, so like this is a daily chart, but let's just pretend that this was a 512 tick chart or a 1 minute chart. And if we were moving lower and then we broke a 61.8 of the Fibonacci retracement and also broke a swing high back here, well, we would expect that now the downtrend is over, which just by breaking that 61.8 down here at 28.31, that's sort of the first indication. And then taking out the swing high up here, looking for a pullback to 28.20s and then a rally to follow, this 28.20 being the start of that uptrend, is basically how I would look at an intraday chart. So like over here, let's just taking that same example. Okay, here we're in a downtrend. We've got lower high, lower low, lower high, lower low, going down, 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 and then we come down here. We finally break a 61.8, and then we break the swing high. That's the key, breaking the very first swing high after the downtrend, because up until this point right here, where we take out this swing high, move above it, none of these swing highs have broken the prior one. This swing high is lower than the one up here, and that's lower than the one up here. And then we have the low back here, and the next low is lower, the next low is lower. So just, going back to the basic fundamentals and the structure of the market, this is the first indication that a trend is about to change when we break the swing high. So then just by looking for the market to make that pullback on the new retracement long 28.9750, that's what gets us into the upside trade that then can either start a more significant long trend, or in this case, only goes for about 5 points before rolling over. Not quite a double top, but certainly getting some resistance up at highs. But you can see how if you're getting in at the start of that trend change, here's the downtrend, and by getting long very early on, you now have 5 points of profit potential here, as opposed to trying to get long up at highs and then the market only goes another 1 point. So on the daily chart, that same sort of structure is starting to unfold here, where we have the strong rally and then followed by the bull flag. I would expect us to come down to 28.20, but with this bull flag forming, we may not get all the way there. We may, dip, form like a hammer, or even come out of this consolidation just straight up. So I've got the still this swing high at 29.1150 is that line in the sand. And this is one reason why I will, rather than like for a longer term portfolio, rather than sort of get in and get out of the SPY by getting long and then closing out and then getting short and then closing out and then getting back long, I will look to add to my longer term positions on a gap up down at lows, using that as sort of the long-term long, if you will, and then just putting the hedge on when we make the pullback, just a short-term short or hedge. Now I can still collect the dividends longer term with the move up and then going forward, having those shares. And the short-term hedge then just comes off once the downtrend is over. So, as a intraday trader, there's a lot of things that can carry over to your longer term perspective, your entire portfolio. You can think of yourself as kind of a hedge fund manager, if you will, and your assets are the fund that you're trading. You don't need to overcomplicate it. I'm a big fan of keeping things as simple as possible. And so right now, this little rectangle box that we've created up here has a high at 29.1150 and a low down at 75.25. So those are the kind of the two lines in the sand. Anything within that, especially tomorrow and in the morning on Wednesday before the announcement, can be a little bit choppy. So fading moves in this range is probably be the only trades that I might take tomorrow. Thursday after the FOMC, however, tends to be the start of some really good trading. So we'll look forward to that on Thursday. You can tune into the live trading tomorrow, Tuesday. Just head over to eminimind.com/VIP. And if it's a slow day, we'll be able to answer a lot of questions and talk about some different things in there as well. So hope everyone has a great week and great trading.